Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. A short while ago, President Trump outlined plans for a bilateral meeting between Russian President Vladimir Putin and Ukrainian President Volodymyr Zelenskiy. Trump said this will be followed by a trilateral summit involving Putin, Zelenskiy, and President Trump. Trump went on to say the U.S. would coordinate with Europe on Ukraine security. We heard earlier from Ukrainian President Zelenskiy.
All of us want to finish this war, stop Russia and stop this war. We spoke about it, and we will speak more about security guarantees. This is very important that the United States gives such strong signal.
Now, Zelensky went on to welcome U.S. backing for those guarantees, and he stressed that any territorial issues would only be discussed directly with Vladimir Putin. For a closer look now, I'm joined by Michelle Jamrisko, White House editor for Bloomberg News. She is on the line from the nation's capital. Good of you to make time to chat with me. I'm sure it's been a busy day for you. So we know at today's meeting, it wasn't just Zelensky who was in attendance, leaders from Europe as well. What do we know about how the meeting unfolded?
It's actually remarkable. I mean, a colleague was joking that it's hard to bring together the G7, but this was most of the G7. Usually it's a year of planning to get them all together. They came, some of them off vacations to the White House today to really show a sign of support for Ukrainian President Zelenskiy at what was expected to be a pretty pivotal meeting as they try to convince President Trump to stay engaged with the Ukraine issue and not give away too much as they had feared would come out of the Trump-Putin summit on Friday, but also to get further on the security guarantees. As you mentioned, that was a key focus, I think, of all the European leaders, and you heard it from them at the top of their meeting with President Trump, that they really wanted to kind of hash out how this would be coordinated, to how this signal would be sent to Russian President Putin that this is an important guarantee in any sort of peace agreement.
I'm imagining that the territorial issue is super sensitive, especially for Zelensky having to surrender certain areas of Ukrainian land in the eastern part of the country. What do we know about that?
Well, this is where it all comes down to, what might be hashed out between Putin and Zelensky, if anything. I mean, Zelensky has asserted that he will not, under any condition, give up territory, that he's constitutionally prevented from doing so. And yet this seems to be the only thing that will keep Putin at the negotiating table, is the prospect for just doing a land swap. We have heard from President Trump at different times, including over the past week, that land swaps have to be part of any deal. He recognizes that, Putin's absence on this has not changed. So that's going to be the next step. But I think what you saw today was, finally notching some sort of outline of a security guarantee that also might run into problems with President Putin, who, as I understand it, is none too pleased, and his foreign ministry said so today, with the thought of having any sort of Western or presence of troops in Ukraine for the long term.
It sounds almost like it's going to be a NATO-style force, right?
Yeah, I mean, that's what's being talked about. But this has really gotten to be an interesting conversation, especially with we had U.S. Special Envoy Steve Witkoff on CNN on Sunday saying, yes, there is a sort of Article 5-like understanding. And he used the term referring back to the NATO article that says, if one member is attacked, all members are attacked. So to grant this to Ukraine, which is not a NATO member, and as Trump has said, will not be a NATO member, that is kind of de facto running against what Putin has said he will not accept, is any sort of that presence or that security guarantee. So we'll have to see, how this plays out when they get to the next meeting, which, as you say, is supposed to be Putin and Zelensky themselves before the trilateral that includes Trump.
So a couple of issues come to mind as I'm listening to you. One is the notion of a ceasefire. Where do we stand in that regard? The other would be Russia looking for some sanctions relief. Do we have any sense of that?
Well, on both of those, I mean, those were the two that I was thinking of that were clear losers today for Zelensky. Amid all the niceties, they had a really good rapport, both in the Oval Office, Trump and Zelensky, and then later with the European leaders. A lot of happy talk. There was a demonstrable change in tone, especially from the February Oval Office meeting between Trump and Zelensky. But two things that he seems to have lost out on. Trump is still insisting no ceasefire needed. He points to, he's kind of campaigning about himself being the president of peace, as he's self-branded, and talking about all these other deals that he's made and all these other conflicts he's resolved in the recent months, not needing a ceasefire. He says we can go straight to the negotiating table and hash out a peace agreement. So now he has kind of dropped that, whereas a week or so ago, he was pushing for Putin to stop the fighting immediately, and then we talk. Now it seems to be we can talk and you can continue fighting, de facto allow you to keep going as they have been, with Russian strikes on Ukrainian cities happening daily.
That's Michelle Jamrisko, Bloomberg News White House editor. Meantime, traders on both sides of the Pacific are looking ahead to remarks from Fed Chair Jay Powell. On Friday, he will address the Fed's Jackson Hole Symposium. In a moment or two, we'll hear from Michelle Martin, president at Prosperity. That's the wealth management arm at Eisner Amper. We also got some perspective out of the Asia Pacific from Mark Matthews. He is head of Asia research at Julius Baer. Mark spoke with Bloomberg TV host Shery and Avril on the Asia trade.
So, Mark, there is a lot going on in the background geopolitically, but investors seem to be quite focused on the Fed rate path. What is your read on the bounce that we saw in the dollar this week and whether this would hold? Because I think you still think it's a dollar weakness story.
Yes, April, we do. And I can understand where there would be a bounce because there's an incredible amount of negativity around the dollar. And if you look at positioning in various surveys in the futures market, I can understand why we are getting a bounce. But longer term, first and foremost, they're running a very wide budget deficit, which I think will probably settle at about somewhere between 5 to 7%. And countries that run that kind of deficit have weak currencies. I mean, if you just look prior to COVID, the U.S. ran a budget deficit of about 2 or 3%. So now we're at about 7%. And Egypt has a 7% budget deficit, and they have a B- rating, which is 14 notches below the United States. So number one, budget deficit. Number two, we're looking for substantial rate cuts. So we're looking for 4 rate cuts between now and March of next year. Normally, when central banks cut rates a lot, the currency goes down. I think it's fair to say there's a lot of unpredictability in U.S. policy across the board. And am I missing anything? I guess yeah, that's the reason why we're looking for the dollar to be weaker over the next 12 months.
Okay, what about U.S. stocks, though? Because they've bounced as well. Yeah. We've seen from these tech earnings the CapEx spend related to AI. Is that fuel for U.S. stocks? And what's your sense of whether this can broaden out? Because it's also about the consumer and the retail earnings that we're getting this week.
Yes, well, 40% of S&P 500 revenues come from overseas. So when the dollar goes down, it's good for them. And for the big technology stocks, it's actually over 60% of their revenues, that come from overseas. With the big spending that the Magnificent Seven are doing on AI, clearly the market is giving them the benefit of the doubt now because all of these data centers and AI chips and cloud systems have yet to be put to use, but they will be plugged in and running next year. And next year, the market will want to see returns. And to your point, they've just spent a tremendous amount of money on AI. I saw a statistic which was $560 billion for the Mag 7 combined that they've spent on AI over the last 18 months.
Given how narrow and potentially fragile this rally is, what's the risk of the Fed disappointing this week at Jackson Hole with really traders pricing in the 25 basis point cut in September and the rally being derailed?
I think, yes, absolutely. There would be some disappointment if the Fed doesn't cut rates in September, and we are expecting it on the back of the very weak non-farm payrolls that were announced in July, the July payrolls, but also the revisions for May and June. Yeah, there would be some disappointment there. But I think that it's fairly inevitable that we will enter a rate cut cycle, if not in September, then in October. And the reason for that is simply that more and more of the Fed officials are coming out and saying they think that rates should be cut. And we are starting to see softness in some data. The Fed likes to be ahead of the curve, not behind it.
We have seen softness in the economic data also coming from China, and really more speculation that we potentially could see some stimulus. Chinese mainland stocks seem to be getting a boost from that. Do you expect this to continue?
I don't think the breakout in the Chinese market is based on stimulus. I don't think people anticipate much stimulus in China, but certainly more policies that are conducive to economic growth in terms of, being friendlier to the private sector, and that's been a trend for over a year now. But to my mind, this is a retail rally that is now expanding into large stocks. So if you look at the performance of the CNI 1,000, the 1,000 largest stocks in China, so far this year they're up 14%. But the CNI 2,000, which is the next 2,000 largest stocks in China, that's up 38%. And retail investors like the stories in these smaller stocks, be it AI or robotics or aerospace, and they've liked the fact that institutions don't own these because they're worried if the market goes up that institutions will sell their holdings that they bought years ago. But now we've had this pretty substantial breakout in the Shanghai Composite yesterday, breaking above its high of March of 2022. I think we're actually at the cusp of a very powerful rally in China, not so much predicated on impending stimulus, but I think momentum, really. It's a good old-fashioned retail market, and the margin debt in China today is 2.3% of market cap. Back in 2015, it got up to 4.8%. So I believe there's more to go.
Yeah, I was just going to ask you, the importance of the retail investor, how much confidence is there on the mainland? We're seeing turnover continuing to pick up. They're sort of sitting on household savings as well. How important is that as a factor?
Very important. Mainland China is a retail market, and then Hong Kong is an institutional market. But there's a lot of money in China. Much of it is sitting idle in bank accounts, to your point. Also, we should recall that interest rates are low. The 10-year government bond yield is 1.8%. And insurance companies in April just saw a major reduction in the cap that they are their equity investment cap. So they're now allowed to, reduction. So they're now allowed to invest a lot more in equities. And there are a lot of high-yielding equities in China, which I think you're also seeing. That's another, sort of important reason to explain why the market can keep going up.
That is Mark Matthews, head of Asia Research at Julius Baer, speaking with Bloomberg TV host Shery and Avril Hong here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. It was a quiet start to a busy week for markets. The high point will come Friday. That's when we'll hear from Fed Chair Jay Powell. He'll speak at the Jackson Hole Symposium and unveil a new policy framework for the Fed. He may also drop hints about the Fed's thinking when it comes to whether or not we get a rate cut at the September policy meeting. Now, before Powell speaks, we'll have the benefit of the minutes of the last Fed meeting. Joining me now for a look at what we may expect is Michelle Martin. She is president at Prosperity. It's the wealth management arm of Eisner Amper. Thanks for making time to chat with me. What do you think we're going to hear from Powell?
Well, Doug, I think it's going to be really interesting. He's really balancing a couple of different things here. One is we're starting to see some signs of weaker growth and potentially a little bit higher inflation mark. So the question is, what is the priority here? And wondering also, what is the tariff impact really going to look like? It's had a pretty gradual impact. We're just starting to see the signs of maybe a bit of inflation seep through. So he's under pressure. We anticipate a rate cut probably in September. But as I always think, the market tends to think that rate cuts are going to come more quickly. So depending on what the Fed minutes looked like and just really what we're going to see from him, I would say that we would likely see a rate cut in September, but I'm wondering if it might be more muted than what the market is looking for.
So possibly one for the remainder of the year, and that's it? Is that a possibility?
If I were to take a bet on that, I would say that would not be out of the question. Again, it's going to really depend on the perfect landing here. We're seeing so many things come through with the markets that we'll continue to see some rate cuts, but I'm not sure they're going to come as quickly. So I would say maybe one this year and then again in early 2026.
So we're going to get some insight on the American consumer this week. We'll have quarterly numbers from Walmart and Target. Home Depot is in there as well, I believe. And I think it's fair to say that this earnings season has kind of trounced expectations when it comes to the S&P 500 companies. And I thought it interesting today that strategists over at Goldman Sachs were saying that companies essentially found ways to blunt the impact of tariffs. And they also were able, if you're a multinational firm, to benefit from a weaker dollar. And if you look at what analysts are doing now, they seem to be ratcheting up expectations for the current quarter at a very, very brisk pace. How are you feeling about the equity market and the earnings season?
Well, the earnings season, as you said, Doug, has been a wonderful surprise in many ways to see some headwinds and companies really be able to perform the way they have. There's a fair amount of cash that is on the balance sheets right now, just due to some certainty in what we're seeing with the new tax law. That's a bit of a break for companies, and just having that certainty and knowing what cash flow looks like is also another contributor to what we're seeing with company buybacks and some of the reports that we're seeing.
In terms of geopolitical risk, we were talking earlier about the situation with peace in Ukraine. Is that a big factor for you right now in your decision making when you look at some of the geopolitical risks that are out there?
Well, it's interesting, Doug. I think that sometimes the geopolitical risk gets magnified by us as consumers or investors in the market. And oftentimes we don't see the impact as strongly. But I do think that it has done a couple things. One is that it has unified Europe. We're seeing that. We're seeing a much stronger presence. I think that what we're seeing along with that is a commitment. And this all just contributes to the commitment of the European leadership to invest in infrastructure, invest in defense. We're seeing some monetary easing and just general deregulation, which is all leading to a much stronger market abroad than what we're seeing even here in the U.S. So that really does play into some of our tactical shifts that we're looking at and just seeing the momentum in Europe.
You mentioned tariffs a moment ago. Maybe we can talk a little bit about industrial policy from the Trump administration. One of the things that Bloomberg News has learned is that the Trump administration is considering taking a 10% stake in Intel. That would follow similar moves from the administration, such as the golden share that the administration took in U.S. Steel, and then there's that preferred equity stake in MP Materials. Give me your sense of what you're getting from the administration in terms of industrial policy. I know there's been a lot of emphasis on trying to bolster certain areas of American manufacturing to reshore production facilities. How would you evaluate the story right now?
Oh, I think it's just stunning. I think that there's some continued protectionism here and really a play to a defensive play against China, particularly in the chip market, and just a retrenchment of investment in U.S. manufacturing in general, particularly as we're in this AI segment where everything is moving so quickly. I was just on a call last week and we were just talking about how chip manufacturing, AI in general, has gone from almost a startup type concept to really being implemented across companies globally, but particularly in the U.S., we're seeing day-to-day practices where that's actually happening. So I think that the administration is actually investing and really getting in front of this AI race with China.
Okay, we'll leave it there. Michelle, thank you so much. Michelle Martin, she is president at Prosperity, the wealth management arm of Eisner Amper, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.